venture funds, and why are venture funds like this so important to transfer the give back component, the additive incremental component. We're going to dig into a bunch of details, and I've got three panelists that are going to help us talk about this today that are all extremely talented and successful in their own right in this space, and all have great stories to tell about why this is interesting to us. What you heard from Fletcher earlier today is that at Arizona they have raised two funds. They're raising a second fund now. 20 million was their first, and then they've got a second that they're raising with a target of 100, and they're deploying it, and there's already sort of success cases coming out of it, which is really interesting. But University of Arizona is not the only university that's been doing some of this, nor the only university that's been looking into some of this. It is a newer trend. And you saw some of the gifts that I put up in this space. So the alumni wealth interest in this space is newer, but this is one additional pathway, right, for some of that capital, and it's a very different pathway. And we'll dig into that. So to cap it off, I'm going to ask each of my panelists here to introduce themselves, say a few words, not just about who they are, what they do, who they're with. But also just kind of their background, what led them to get into this space, and why this is such an important time, I think, for doing some of this. Not an inflection point, but the trajectory of this right now. And Mike McCord, why don't you start us off?
Yeah, thanks, Ian. Thank you, everyone, for being here. Cool, thank you. So my name is Mike McCord from Raleigh, North Carolina. I grew up in a family of scientists, so being from Raleigh, massive biotech scene, kind of veered off course a little bit, got into finance, studied finance in undergrad, out of college, worked for a CPA firm for a number of years. Didn't really like the structure. It was incredibly structured, not a lot of problem solving. So very quickly found a startup environment very interesting. Got involved with a fintech company that is now one of the larger crowdfunding companies. So kind of the backing up to the genesis of that company, they had very large capital partners, traditional real estate developer, but it struggled to raise $1 million. So the dynamics at the time is when you have big institutional money, they can maybe deploy, they can maybe write 10 checks a year just based on bandwidth. And if you want to do $1 million project, good luck. So the approach at the time was take a traditional real estate syndicate and put it on the internet. And what kind of emerged from there was what led me down this path I'm in now, where I'm now kind of marrying this fundraising syndication online with commercialization. So after that, I've been CFO of a number of companies, life science companies, and have started a company called Alumni, which allows alumni of schools to invest over the internet.
Easier. Tim Sherrill again, give you a little bit of my background, a couple points I may have left out. One, my daughter graduated from UK last year, and she loved the dance balloon. Before, absolutely loved it. It's a huge, great event for students. She's now an ICU nurse up in Cincinnati, and UK was fabulous compared to all her peers from other schools. UK did a wonderful job. So that's that. I also mentioned I grew up in Cleveland. Actually, went to Case Western, first generation college student. So a lot of my, motivation, passion for trying to figure this out, and why now relates to this, is because I am from here, and I've had pressure to move to the West Coast. I've mentioned I've had offices out there a lot, but I don't want to live there. I like visiting, but I don't want to live there. My daughter's there now, another daughter. She's a designer, lives in San Francisco, and I think I might get a text any minute. She's quitting, which is good. She lives in the city, and she's coming back. So kind of predictable. So the timing is there's a huge, I think, macro trend right now in terms of some of this, combination of anti-Silicon Valley sentiment, combination of the cloud and mobile means that innovation can happen anywhere. people can choose to have, why can't I have a great company and a great family, right? I don't have to give those things up. And so I think there are a lot of macro pressures right now causing this opportunity to happen, as well as the downside pressures of universities are facing, which is state support, from a funding standpoint. So the idea of commercialization generating a bigger percentage of revenue is also increasing.
Great, thanks. Please notice that I'm the one wearing khaki pants, not tight lime green shirt. And, I come at the venture capital world in a very non-linear way. My background is sports and sports investment. I used to run business development for a company called IMG. And those of you that I'm actually Matt Briggs, used to be on our team here. I used to live in Lexington. We gave Mitch Barnhart the largest 10-year contract that we'd ever done in 2003. We gave him $80 million. And that was for the right to basically take athletic rights, and then on an annual basis we would commercialize those rights. So we would pay them, we paid Ohio State $120 million. But we would take those rights, and then we would hire a staff of people, and then we would sell the commercial airtime for radio, broadcast, television, John Calipari, well before John, Tony Smith's likenesses and whatnot. So I come to this from a real pure commercialization standpoint, where we have a lot of fancy words, but this really is about making money for the university, making money for the potential entrepreneurs involved, and as Tim said, it's about the focus on how to create this gap. Privatization was a big thing for us when I was at IMG before I left. We looked at the Ohio State privatized their parking infrastructure, and Indiana thought about it. They got Gordon Gee got $450 million by leasing their parking for 50 years. And what persuaded other universities not to do it was because the tenured professors got upset about the price increase. And so as this pressure continues to mount on alternative sources of revenue for these campuses, privatization and venture become a much bigger part of that.
So before we dig into business model and fundraising like this, and a lot of the questions that I'm going to try to steer towards interest of the group here, Tim, you have had significant experience deploying capital and making some of these investments, and you've seen the real impact, right, of venture money to early stage technology development, early stage startup development, some of which have come out of universities, and the work you've done at Centrifuge, or you did at Centrifuge in Cincinnati, and as that touched even the universities there. Maybe just speak to the importance of filling this gap with some of this capital. And before we get into sort of the nuts and bolts of raising these funds and things, just speak maybe to the importance of having this capital available, whether it's captive or not, just the importance of what it can do to, just as a transformative measure for a community and for a university-driven space.
Sure. So when I think about that question, I think you really have to have a portfolio approach. So there's not a one-size-fits-all. Just having a university-oriented fund is not the answer to all your problems. Having a seed stage fund is not the answer to all your problems. It really is a portfolio based on stage and expertise and vertical or domain expertise. So, and that's part of what we try to do, a big part of what we try to do with Centrifuge. It was created by the big companies in Cincinnati to basically be Switzerland, right? And to work with everybody, the existing seed funds like Cincy Tech and Queen City Angels, and really on behalf of the entrepreneurs. And what they did, when they started Centrifuge, it started with a study from McKinsey that showed where the gaps were. And what they actually came up with was that Cincinnati, from an angel investing standpoint, was actually slightly above the national average. So that wasn't really the problem. The problem was the next stage of funding. And that's what we were there to solve. So we were looking to invest in venture funds that did more seed or Series A. Okay. The other neat advantage we had with Centrifuge, unlike prior state-backed programs, state-backed programs that try to do fund-to-funds activity, is we changed the rules. We swapped the priorities in terms of what we focused on. The state would say, we'll invest in you if you invest here in the state. You must invest here. The for an investor who's commercially oriented, I don't want to deal with that. That's a bad idea. I want to invest where the ideas are, right? So you get adverse selection. So what we did is we said we're going to focus on funds that have, first of all, great performance. That means they must know something. They know how to help cultivate, source, cultivate, and grow companies. And then the secondary thing is, will they engage? Do they have reason to engage in our community? Maybe because a lot of their startups are going to sell to Procter & Gamble or something. And we found that really worked. So we invested locally as well as nationally to build this network and fill in a bunch of dots that weren't getting filled in otherwise. And the only other fund like this I know in the country is Renaissance in Michigan, and they have the same approach.
Yeah. So, Mike, you gave a little bit about your background, but I think most people in the room, maybe all the people in the room, aren't familiar with Alumni shares. Maybe you could just dig in a little bit to the business model, not just sort of why or how you started it, but what does it do, how do you work with, and how do you work with them?
Yeah, no, absolutely. So Alumni Shares is a software platform-based approach. So if you think about like social media companies and where they were in the Friendster, MySpace days, they were largely unstructured. There was no context whatsoever, right? And then Facebook came along and they created deep context and deep structure and plugged into probably the strongest network in existence, which is university ecosystem. So thinking about the problem in terms of a network and thinking about the importance of network effects and nonlinearity and addressing that problem and feedback loops, like we're sitting on top of a massive network, and it's a matter of connecting and providing that structure and context across that. So what we're focused on a lot is on the product side in terms of actually developing a software product. It's highly personalized. It delivers an incredible experience, and then working with amazing schools to bring awesome investments to bear. So, right now the schools we're working with the most are NC State and Duke. We're in Raleigh, North Carolina. We've done a number of deals out of both of those schools. And then we're looking to expand as we continue to kind of build up our platform.
Okay. Let me do the same lot with you. We've heard some of the details of what's going on at the University of Arizona from Fletcher, but maybe you could just dig in from the Maven Capital side, the services that you guys provide to a university that would be raising a fund like this, any sort of nuts and bolts that we should know about Maven.
Well, I've been around the university community for about 25 years in the commercial space, and so I think Tom talked about the turf and fiefdom, and from the athletic side, the athletic group has got a 4-hour commercial on Saturdays for football, and then here at UK they got a 2-hour commercial on their basketball side. So athletics is a normal place to have a lot of attention. What resonates, Fletcher talked about it today. Fletcher is a unicorn. He doesn't have to be a unicorn, but he is. He's a guy who, so before Maven, we knew him on the sports side. But he's the guy in town, everybody knows him. People are like, that guy makes people money. And every single one of you know who those people are. They're the Pied Piper. That guy's been a public company CEO. That guy, 10 of those guys. So the Maven thought process is about scaling the stuff that Fletcher does really well. And what Fletcher does really well, and what Arizona did, they got out of his way. So it's a really streamlined deal. However, the challenge initially was to go to JB and the folks on the philanthropic side and try to communicate how it was not competitive, it's all incremental for them. And there was resistance initially. And ultimately, I'll tell you what breaks down the resistance walls when you have some success and you hand him a check. So when you communicate, by the way, we'll listen to you, we get feedback, it's incremental, and then you demonstrate that through a track record, that changes everything. So the question about the nuts and bolts of it is, I think people are naturally resistant to doing things that are different. And a lot of people in this room are going to be concerned about, what does this mean for me? What does this mean for my group? What does this mean for this or that? And I would tell you the success of Arizona is really the track record of, rising tide lifts all boats, where, there is money in different places and it's been incremental. So the raising of the money, we actually, Dr. Robbins, who Fletcher mentioned, he solicited 85 top donors. We got in a room like this in Tucson, and he said, look, we've got a massive capital campaign going. I've asked you for 10 different gifts. I want you to give to all those 10, but I really want you to give to these guys. I want you to give to this fund. You know, you can do good by the university, you can also do well. So Tim hit on the right thing. It's about the return profile. If you can make people money, they're gonna be apt to give you more money, and then they're gonna be apt to grow that pool. We had a situation where, in the Symphonia example that Fletcher mentioned, they invested $4 million, they sold the company for $132 million. A lot of people made a lot of money. And the university got a check for $8 million. So that changes a lot of the perspective. But the guys that were gonna give 500 grand or $1 million now can give the university $3 million.
So the decision, Tim, you want to follow
I'm
through?
just going to add on to the nuts and bolts. I was thinking as Lawton and Mike were talking. What I've seen often are universities that want to have, again, a captive fund. And the thing to understand is it's very difficult to attract somebody to lead that fund that has a commercial track record. On average, in a venture fund, you want at least 25 million per partner, 25 to 50 million, right? And if I'm fundraising, if I'm raising the fund, I'm gonna have all the equity in that fund. I'm not gonna say share it, with the university. So I've seen universities come to me and say, hey, we're trying to put together a $10 million fund, and we want you to run it, and you need to go raise it with our help. That doesn't work, right? So I think, the bias should be leaning towards commercial partners that show that they have an interest in partnering and have some natural affinity to what you're doing at the university, so that you're taking advantage of those skill sets that are going to be in those commercial funds versus someone who's going to potentially run a small fund. Because part of what happens is, back to the ecosystem and the portfolio, what's really important is that those early investors have the connections and networks to the later stage investors. That's why Citrifuse was created, because the early stage investors didn't have those coastal connections. They couldn't pick up the phone and talk to somebody in Benchmark or Excel or Sequoia, right? And to get those people, they need to go somewhere where they're going to have great returns themselves, right? So it's really important at that earliest stage. It's not just allocating or doling out money. It's getting connected into the right networks.
So, Lawton, can you comment on that too? Just because that's something that might be something that may be unclear, I think, to the whole group here, is that the fund here, as it relates to Arizona, may or may not be just alumni money. I mean, there's institutional money that's interested in this.
No, it's totally true. I mean, we're actually, right now, we're in the stage of agnostic money, as Tim said. So the first step is the economics. I mean, again, a lot of people, I've faced in my entire career, everyone who says, no, can't do that. That's not the way it works. Can't do that, can't do that. And candidly, people don't want to be first. They all want to be first to be second. So now I can tell you that in the last maybe 100 days, we've probably had 15 phone calls from senior level executives at universities saying, University of Arizona is known for bikinis and basketball. How are they now becoming a leader in venture capital? There's no actually captive venture capital in the entire state. So the answer to the question of sort of the agnostic capital is return. So Fletcher, the other thing that Fletcher is really interested in doing, and I think this is a little bit different, and Tim would probably agree it's a little bit different, is that Fletcher's 69, looks pretty good, but Fletcher also is not someone who is saying the traditional venture world of a 10-year hold. Fletcher's like, look, we're going to identify things that can potentially have a quicker exit. And that might not generate the type of multiple on that deal that is a pure venture profile, where there are 5 follow-on investments and there's A, B, C, and plus further rounds. So Fletcher's had success in having 1 exit in 31 months. He's got 2 or 3 in Fund 1 that have the chance to exit now. And then in Fund 2, which is not even, we're 25 million or so out of 100, he's got something that could exit already. So it's a quicker profile. And I do think that there's an interesting IP arbitrage where he's not waiting for the mandate for late stage. And so the more activity and the interest level attracts agnostic capital. And, you know, by the way, a year and a half ago, you sit in this room in Arizona and 85, 90% of the people were like, can't have it. So the truth is people like Tim and others that are the deployers of the capital would love to see a 5-year track record profile or 10. But there are some risk initiatives that can be taken to accelerate that, and all of that is about return. If we can call it whatever we want, but it really is about making money.
Yeah. And I heard him mention, you know, early stage fund can't get money from the endowment foundation.
Yeah, right.
Which
Yeah.
I felt that face as well. I'm actually chair of the investment committee at Northern Kentucky University, and so I know what that looks like. You know, it's very risk adverse. There's a huge opportunity, but also a couple of challenges. So first of all, 47% of all pension money that goes into venture capital comes from the Midwest.
Right.
It doesn't go into the Midwest, where it goes, right? So there's a lot of money, huge pools of capital. Some schools don't have a large allocation to venture capital and private equity, so that's one problem. You gotta educate the investment committees. But if you can, and this is the benefit of having an agnostic fund that's not solely limited to one university, it increases the chances that the endowment or foundation can invest their capital, because now you look like other venture funds out there. Right? And that's using the power of their purse. So they can say, just like we did at Centrifuge, look, we love your firm, we think you have a great track record, we're going to invest $20 million, but we also want to see that you're going to spend time here at the university looking at things you're spinning out. Right? I think that's a huge opportunity that I see very few universities taking advantage of.
Yeah. So Mike, let me let you answer the as you know, your model is definitely a different one, and people might be wondering, is this crowdfunding? Are they accredited investors? How do you do that back office support stuff? Maybe speak to that, and is institutional money a part of your model?
Institutional money is not part of our model at present. Right now, we're looking at an engagement approach. So how do we not get money just from today? So the last deal we did, we got money from maybe 50 accredited investors. Over time, where we want to land is unaccredited investors. The new person who graduates college can set up auto invest and deploy incredibly incremental money, $25. $5, right? Similar to Robinhood, and create that touch point early. So what we're seeing across the board is, well, there's a massive transfer in wealth that's happening. So kind of going into that and why it led us to this conclusion. So if you look at kind of the millennial subgroup right now, out of 90 trillion household wealth, it consists of 5 trillion of it. By 2030, they're saying that'll be around 25 trillion. So that's a 5x growth factor in a little over a decade. That's significant. And the way that these people are engaging is totally different. So a lot of it's mobile, a lot of it's around video, a lot of it's around podcasts. And we want to make sure they're included in this process. And the way they're investing is totally different too. So if you look at Robinhood, and you look at the #1 company invested in there by far, it's Apple. It's not Apple because of their balance sheet. It's not Apple because of their EBITDA multiple. It's Apple because people trust the brand. They really do. And so we're seeing this shift from transactional to relational, and there's this massive opportunity, like, for universities to fill that need.
So you're saying people can trust the brand of a university the same way?
Absolutely, absolutely. And that can be one. The investment piece is one tool in the toolbox. It's not the whole thing. So we're really focused on that. Right now it's accredited only, but previously there's something called the Jobs Act where it allows for a miniature IPO. It came out June 19, 2015. I filed the first one in the country the day the rules went effective. Raised $50 million in that for over 10,000 people. And that was without kind of having this massive built-in audience. So this is something that's possible and happening already. And I think, around opportunities to really impact people in trusted brands is just so obvious.
So I want to dig in. You mentioned earlier something that is certainly going to be of the minds of the philanthropy groups in the room, the incremental piece. So every time we've talked about this, you've had a really good answer and sufficiently convinced me. Dig into sort of how we know that's incremental dollars. I know Fletcher had an awesome model where he was talking about sort of earmarking proceeds and coming back. You mentioned the 8 million. But other than, incremental in a sense of coming from a different bucket of money, investment versus gift, we talked about.
Yep, I think the easy answer is that we actually didn't really know. We said that a lot. We went out and proved the thesis accurate, is that when you talk to the high net worth individuals, the donors, all of a sudden, as opposed to a charitable gift conversation or a commercial conversation on the sports side, their investment advisors got involved in this. So this became an active environment where they were spending money out of a different complete pool of dollars versus their charitable or social gifts. And so we now have a defined pathway for being incremental. And the other thing that is helpful is we are now, because in my experience, and I know this from the commercial side, people are relatively tired of the same ask, and you guys might feel that way. Especially a high net worth individual, a lot of them don't want to put their name in a building anymore. And there's only so many, only so many spots on the charter that can fly with Cal, right? And they don't want to go to the away football game. And so you have to come up from a philanthropic standpoint, something that's different. And so that's where we see incremental. And I have a bit of a question. I don't know the answer. I think I do. But say in Indiana, how many alumni percentage-wise give back? 15%? 18%?
I don't know the answer to that, but I do know that a certain number are very key, and but then I think we do the same ask.
Same thing, right?
Ask.
So what about Kentucky? 15, 17%?
It's like 35,000 out of 200.
Right? Is it right?
Or something like that.
So it's 15, 17. Is that about a consistent? We hear that range is pretty much 2 million, same thing, and then so smaller. So I think the opportunity that we find, and Tim, as you guys can talk about this, but so that leaves 85% of the people that you aren't getting money from. And opportunities for new ways to communicate with them are really relevant. And the other way we know it's incremental, to answer your question, Ian, is that Fletcher provides a monthly and a quarterly, for all venture funds, you have to have communication by law, you have to file K-1s, et cetera. There's a communication process and allows for a completely different dialogue with high net worth individuals. So you're communicating with them on a monthly basis or a quarterly basis about something that they're highly interested in. And it allows a completely separate set of conversations. And so we have not built a business construct around alumni only. We believe that there's a lot of agnostic money that's going to come in.
Yeah.
A little bit different from Tim is that we probably are going to start with individual schools and not have a parent fund. We're just going to be focused on those. And then we'll have to grow out of that. But it is incremental in every way.
So only because you mentioned the K1 really quickly.
Yeah.
On the taxes stuff, right? Big on, we do gifts because it's taxed favorably and different pot of money investment. What are the impacts or implications?
Well, I mean, if you make someone money, they're gonna pay taxes, but there are different ways to do it, and there's smarter people than I am that are estate planners in this room and that corner of the room, but there are ways you can have a tax efficient process with someone can custodial the IRA and drive it through the fund. But I think number one, people understand that this is a for-profit entity.
Yeah.
And by the way, we don't disguise that. We characterize that Fletcher is a for-profit guy. He's made people a lot of money. They pay taxes on that money. We carry all of the investments are carried at the cost basis of the investment, so they're not what they call mark to market. So we don't try to grow the valuation on an annual basis or a monthly basis because someone has demonstrated interest or activity in the space. So we'll carry that at the cost basis. That makes it a little bit more difficult on the institutional side. But as far as the tax impact, my experience was I happened to be in the room when all of the GPs got their Symphonia exit about 6 months ago. It was nauseating, by the way. But they recognize that that's a tax bill they're very happy to write.
Yeah.
I think you'd add to that. we've done some of those vehicles ourselves at NKU.
Oh, okay.
Yeah.
So you mentioned the GPs. So, you know, Fletcher is the GP. I don't know, you call them the secret sauce, right, to the Arizona approach. How important is that? And then, Mike, to your approach, is having a GP or something like that as important? Someone working alongside you. How do you work with the philanthropy group to do yours if there's not sort of a GP, a Fletcher McCusker out there helping you do that? Maybe you can speak to that.
Yeah, no, absolutely. I mean, it's critical. Just to reiterate what everyone's saying, returns are first and foremost everything to people. If you don't generate money for them, it doesn't matter how good you make them feel in that interim period, it's not coming back. So we have a fairly traditional venture team kind of behind the hood. So Omar Flores, a guy, he's a PhD in molecular pharmacology, formerly at Hatteras, Mountain Group Capital, kind of traditional life science VC background, heads up our life science venture team. I mean, we have a pretty traditional profile in that respect. In terms of giving to the school, we give a portion of the carry to the university.
Okay.
So, and then similarly, we haven't had any exits on it yet, but based on conversations, you know, fully expect people to be giving upon liquidity events.
Right. And Lon, you guys have seen that. Arizona, that's happening.
Yeah, they've actually earmarked. So we have a couple of folks that have been like, well, I want 80% to go to athletics. Which, by the way, if you want to talk about fiefdoms, like that's one way to get around it, is say, okay, well, we were going to ask you for $1 million. Instead, you put $1 million in our fund, and if it's successful, then you're going to get $10 million. And I'm assuming it's a 10x return. So 30% is going to go to the general, 20% is going to go to fine arts, and 50% goes to athletics. And we've had a couple of guys who are, or gals, who've been like, yeah, we'll do 100% to athletics, or we'll do 100% to general. But it allows for them to feel like they're in control of a much bigger pool of money. And it's just a simplistic conversation. GP is the critical, finding the right person, Tim will tell you this, is absolutely critical to both run the fund and have the connectivity to the university, and being able to cross collateralize all of these different areas of the university. But you know, those are not easy to find.
Right.
So you have to think about here, Kentucky's got 288,000 alumni, right? Living alumni. I would venture to guess there's probably a couple hundred to pick from.
Yeah. So that's my next question. Fantastic, you got into that. What I'd love to know is what's the ceiling on this? Because so we know how 85% or whatever the number is that don't give back is the highest expectation to the university. Tapping into the people that don't give, or tapping into a new pot of money from the people that do, right? Because out of that 85%, only a small fraction are accredited investors. And if we're only doing accredited, you know, of those, you know, new pot of money, or is it a new part of that pool of accredited investors we're
Both.
most focused with? Okay.
But I mean, both, plus you're going to have agnostic institutional capital that is searching
Yeah.
for, I don't know the final
That's-
numbers, but there's something like $3 trillion sitting on the sidelines right now. What is that, the number 10? So that's not invested right now in the market, just sitting waiting for opportunities. So there is a significant capital need. The one thing that all of you university environments have is proprietary deal flow. Fletcher has an exclusive first look at everything created in Arizona. So it's a right, not an obligation. So if someone files a patent, I'm assuming the same way at Ohio State. Someone files a patent, then Fletcher gets an exclusive first look. Now he can pass, or the person can say I have a valuation of 20, pre-money valuation 20 million, and Fletcher's going to say forget it, go to Silicon Valley. And most of these professors don't know even where Silicon Valley is, so they're not going to go. So he's got a hometown advantage in the fact that he's got captive capital right there, and he deploys it very quickly. You know, in a situation a couple weeks ago, idea, been around, LOI, deployed the capital within 4 days. There's no committees, it's Fletcher and his IC group. It's really, really seamless. And it's really meaningful to have that perspective. And it's also really meaningful for this group to have a sense of urgency to tap into those three buckets: institutional, agnostic, and then both the alumni that give and the alumni that don't give.
Yeah. So I'd love to, yeah, go ahead, Mike.
Yeah, just one additional thing to add. So I'm fairly convinced at this point it's fully incremental, particularly from that first group. So if you look at last year, there was more, in 2018, there was more money raised in private markets than public markets. So a huge portion of people with a lot of money are way over allocated in public markets, and getting that money from them is coming from Schwab, it's coming from Vanguard, it's coming from Fidelity. I mean, fairly obvious.
To go on the deployment of the capital question, Mike, for you, as you've worked with Duke and NC State, have those institutions gotten to the point of deploying any of this capital, and what are the rules around that? So as the funds, the deals that you've done, and the money that you've raised in that manner, what are the strings? Is it first right of refusal, first look? What is it?
Yeah, I mean, we have a real informal relationship. We don't have any right of first refusal, so we're seeing deals that are coming into us and saying, okay, this is something that we want to do. This is something that we don't want to do. And there are other people looking at them as well, but we're playing at a dollar threshold where we're below the radar of a lot of people. So our last deal, we led a $1.6 million Series A. Other people in our kind of in the local market are not even really looking at that side. They're looking to deploy more growth capital. And to the point of the question of structure, right now we're not doing a fund. We're doing individual deals.
Yeah. Okay. Got it. That's a big difference. Tim, you mentioned earlier sort of a captive fund. This is not sort of one size fits all or one answer to the whole sort of funding need or the gap, right? So to that extent, everyone at the universities in the room and a number of tech transfer offices, you know, we all have angel communities, right? Angel networks that we work with and we put things in front of. The Bluegrass Angels here in Lexington is certainly one of those. How would you expect coordinated effort or filling different gaps in that continuum? How would you expect that might work best with the angel communities that's maybe already there, and then a large university raises a fund like this, and the types of investments, the size of investments, and the difference?
Well, first of all, I think platforms like Mike's, could really help. And there are more platforms like the, AngelList or what have you. What we've seen, what we can talk about is in terms of the downside. Like in Cincinnati, we have 2 state-backed seed funds, and most angel investors are investing through those.
Yeah.
So if an entrepreneur goes and pitches one, they say no, and the next one says no, they're done. And I think the advantage of angel investing, especially at the early days, beauty's in the eye of the beholder. You want a lot of different choices of investors, right? Somebody might like the idea. So I think educating the angel community, helping them to see the deal flow and be aware of the deal flow, but not trying to consolidate it.
Yep.
Like I would not try to put them all into one decision-making bucket by any means, right? That will ensure that more deals get funded and at least get a shot at the goal.
Yeah, and that's where I was hoping you would go with it. I think that's right. Thanks. Just by the 33 investors that have invested in your fund at University of Arizona, do you know how many of them were or are a part of what was maybe a Tucson Angel firm?
Very, very few. I think we're at like 9 states now.
It's incremental in that stage. For
Yeah.
sure.
So very few are part of the angel group. I mean, the pitch has been to them, has been more emotive. So it's sort of like whoever put the picture up of Rep Arena and said, I want to have people celebrate the venture community of the Rep Arena. This is emotional for the alumni to say, look, you can support the school. It is not emotional for real investors. And all of these folks all the high net worth folks have their own, they're registered investment advisors or their family office. So they all have people that analyze this. And it either works or it doesn't. But as far as being part of the angel community, there really wasn't an angel. There is one in Tucson, but not really active.
Yeah.
And candidly, it was a side job. So the lack of sophistication and interest was primarily, as Tim said, you see deal flow at 7 o'clock, you're running your kid's softball game or soccer game, and it wasn't a priority. What Fletcher's done is professionalize that. And candidly, I mean, I sat across from Zach last night at dinner, and he said that Ohio State's deployed $100 million. Right. And it made me feel insecure because we haven't gotten to 100 million yet. But every school that I know of a venture initiative and an angel network, and so we're not doing anything incredibly innovative. The only thing that we've kind of done differently is sort of reskin it. And a lot of the naysayers, they're still going to be naysayers, and candidly, you need that to make a better process. But they're still the Tucson Angel Network. They're just super bummed out that they don't get a chance to see any of this stuff anymore before Fletcher does.
Yeah, yeah.
Like
So-
really bummed.
I want to talk to the deployment a bit more. Tim, you've had a lot of experience in this. One thing that a lot of the people in the room may be thinking of is their pipeline and how might that match with sort of the demand and the supply, right? How do you put those two together? Some of the universities in the room are smaller, some of the universities are much larger. So different size pipelines, different types. So as we think about it, so we know lots of things need funding at various levels. We have 65 startups that are out there. Some of them are in Series A right now. We also have a lot of technologies. Raja Krishnan, who's sitting back here, my commercialization manager for life sciences, writes me an email every day about a technology that needs funding, whether it's $1 or $2 million today, right? And just so different levels and different types of funding. So Tim, as we think about these pipelines and this type of capital, what do you think is best practice for making sure that pipeline gets to a point, sort of this level of venture funding? And then what's the best way you think a fund like this should review and access those? We know how it's done at Arizona through Fletcher, and so we dug into Fletcher a little bit last night on when he gets to see those opportunities. What's maybe best practice that you've seen?
Well, I don't know. I think I've seen a lot of different techniques. I think the the thing I'm focused on is the talent, obviously. Yeah, I think so many of those, the 60 or so that you have, may not necessarily have a leadership that's able to go attract and pull in the capital. That's often the case, and that's why I've chosen to focus on that. But we've done a variety of events, like in the Centrifuge experience, various networking events. I think what's hard for universities, what I've seen is, like, if they have the tech transfers groups trying to look at licensing opportunities in the university, say, we want somebody to look at our portfolio, it's easy to find big pharma or others because you know who they are. Right? You know, okay, here's the three companies. Ohio State, it's GE, it's Honda, right? They come in every day, they see the IP, it's easy to identify. The problem with venture investors is it's very diffuse. Right? Who do you go to? And you don't know, you want to be able to go to a Fletcher, but you don't necessarily want to go to one person either, right? If you have a big portfolio, so you want to get that exposure. And so you need to create some events, and that can be hard sometimes if you to try to get those investors here. So in addition to doing events like in Cincinnati, we also did roadshows, Silicon Valley roadshows, where we'd set up a variety of meetings, take what we thought was some of our best inventory, and introduce them across the country. So I don't know that anybody's really figured out something that's foolproof, but I think those are some ideas that help.
Yeah. So the process that that is being practiced right now with Fletcher and this group, UABC, how have you seen that work?
Yeah. Well, the first thing is they hired us, which was a little bit of a leap of faith on Fletcher's part. But I learned this from the outsourcing world on the sports side. When there's a problem, it's much easier to blame the person over here who's been outsourced. But it does give an arm's length from a university perspective to where, Fletcher's not having to call his, super rich buddy over here and say, give me money. That's our job. So, and we're very capable and happy to do it. And obviously we get a fee in part of the GP to do it. And that's our job. But it does, universities themselves are not set up as commercial centers. So, historically, this is maybe changing, but, when we were at IMG, we were shocked at some of the really proficient people probably in this room raising big money, but they didn't get compensated like they would be in the private sector. So there's not a traditional structure. If somebody raises $10 million in the private world, they're going to get a commission or a bonus. And they're going to have a compensation system that reflects that aptitude, that quality. And university systems have all just been, our experience has been like, well, you work for us, and they really want to, it's not the name on the front of the jersey, or not the name on the back of the jersey, it's the name on the front of the jersey, and I don't really subscribe to that. So having a third party is critical, whether it's us or somebody else. I would say that is one of the really, I think, positive things in Arizona, because we ultimately can certainly take the no, but we get a lot of yeses from people who don't necessarily want to give you yeses. And those uncomfortable conversations. Bobby Robbins, who's the president, stands up and says, I want you to give to these guys. Well, he didn't say, you know, I want you to give 1 million because I know what your balance sheet looks like. So for us, we then use that as a tactical advantage, and then the fund has benefited from that. And I think Tim would probably appreciate that he's a deployer. So I would go to Tim and say, hey, would you give me $3 million? Matter of fact, Tim, would you give me $3 million? So your fund, would you give, because a lot of funds don't invest in it, but he's going to think about investing in the UABC. So we're going to talk about, like, but he might have a conflict. You know, he might dislike the president, he might not like something going on campus, whatever. So a third party is really important, and it also is set up for success. And I would say the other part, whether or not you hire third party outsource, structuring your donor development, your commercialization effort to where there are incentives for people, all of you in this room, I can't negotiate everybody's contract, but like that's a big missing ingredient.
Yep.
And I still want the $3 million.
I was thinking 4, so you shot well. But this, it does get to the point that I mentioned about the gap, the talent gap. Because as much as I'd like to think I could review the things coming out of the university, I know I can't, right? There's limitations. So my preference is to go find 3 to 5 UK alum that have been part of hypergrowth companies who have a track record of some success, bring them through every year and have them look at that inventory and make a decision, because what I'm counting on is that they're going to make a decision to bet their career on that thing.
Yeah.
And if they say, I'm willing to bet my career on that thing, then I'm putting in $3, $4, $5 million, right? And it changes the game entirely. And you know, I think there's keeping in touch with those people is what I think everybody here needs to do and can do through that network, whether it's using the LinkedIn Sales Navigator or other tools. Just look at, you know, what companies receive venture funding, and keep an alert, you know, in your email for those. And as soon as you see somebody that received venture funding, find out if there's any UK alumni working there, and then start talking to them. They don't have to be founders, right? So there are probably UK alumni walking around New York or Silicon Valley right now thinking about maybe joining a company. And wouldn't it be great if you could call them? Wouldn't it be great if I was alone and somebody called me and said, hey, can we help? We think we can help you. I haven't had that happen, but I think it would change the game if you did. And that's that entrepreneur advocacy that we push so hard for in Centrifuge. We didn't wait for the entrepreneurs to show up. We reached out and said, how can we help you? What can we do to remove the roadblocks? So I think everybody in this room that has access to those connections can do a whole lot more to reach out to those people and start to bring them in to the network. And whether they get funded by, you know, any of us or somebody else, those people are very fundable people, and you need them in your network.
Who, just real quick, who in the room has like an entrepreneur residence program, executive resident program? You guys do. You guys I'll stay to Lane. So that's, I mean, so none of universities have like an EIR type program where they bring kind of talented people back. I don't know if they're not always alums, they're just kind of people that are in and around the community sometimes. But you're talking about something even more so than that, right? Bigger opportunity, or more targeted.
Yeah, I'll be honest and vulnerable. I haven't seen any EIR programs really work. Well, or they're getting paid with no deliverables. So oftentimes, they work well for mentoring.
Yeah.
I think there's a mentoring program that works, and most people won't say this publicly for good reason, but yeah, you're getting people who are between jobs or recently retired. You know, they may not have the ambition, for one. 2, they are getting paid a pretty decent amount for a part-time job, no deliverables, as I mentioned. 3rd, the hardest part is raising money, right? So we're trying to change that by bringing in people who are ready for that next step of their career. They're coming up to bat. You know, they've been in the on-deck circle. They haven't necessarily achieved success yet. And we're giving them a very specific timeline and incentives to try to find something. And it's very similar to, if anybody's heard of search funds. You heard of that term?
You talked to search fund, just the concepts.
Yeah, so the concept of search funds, Harvard and Stanford argue over who with it in the 70s. The idea was MBA students wanted to graduate and go run a company. Well, how am I going to do that? I'm a young MBA student that doesn't know anything. What they would do is they'd go get sponsors, patrons, and they'd say, hey, would you be willing to pledge up to $10 million if I can go find a business to run and transform it, right? And so what they would do is those patrons would pay them a incremental amount of money to fund them and a small team for the period of maybe a year. They'd go out and survey the landscape, usually like business services, nothing tremendously innovative, but it could be dry cleaners or car washes, whatever. And they'd go and they'd survey 200 and some companies, and when they'd find one, they'd issue a term sheet, and their investors would say, okay, now we're putting in the money. It's been hugely successful. The returns in aggregate have been higher than venture. And the secret to that model is you've got the hunters, right? You've got the leaders who are hungry. You're trying to commercialize something and make money, and you're giving them a platform in which to operate. And I think that's the biggest piece that's been missing.
Yeah. Michael?
Yeah, I echo that completely. The conversation can't be around hundreds of people. I mean, there are hundreds of thousands of people in the toolbox, and the needs of a startup are incredibly complicated. So at one point, they maybe need an advisor in the marketing space. At another point, they may just need contact with a critical customer to validate something. So kind of bringing in those people to bear is a critical one.
I want to touch on the separate versus inside thing. This came up last night at dinner in a conversation. I heard from one university say that, you know, what universities do often is create things. They sort of lead the creation of it, because, you know, that's what we do, we create things. But we create it outside of it, and then 10 years later we wish we owned it, and we didn't. But then on the other side, there's this very important sort of separate aspect, third party specialist to come in and help with something, because A, there's a risk aspect also. And of course we would all expect that something like this would work, but if it didn't, if it's not actually owned inside, maybe you don't have as much blowback or reputation risk. But beyond just the risk, so maybe speak to that a lot. And I know that's probably of mind, maybe from some people here that might think, why wouldn't we do this internally through a foundation or something like that?
I don't know the laws in every state, so some would permit it and some wouldn't. I can't imagine that the state of Kentucky would be okay with that, given the train wreck in Louisville.
We wouldn't.
Yeah. The first thing I would say is that to even evaluate either staying inside or going out means that you're really motivated to do something. So that's a really good first step. I think that the turf battle, the fiefdoms, I think it's going to be really hard. Every successful environment's going to go clamor for the success, and they're going to stumble all over each other, I think, to create a problem. I don't know of a university organization internal that would be able to be as streamlined as what has been accomplished with Arizona, and there are a couple of other examples too. Cal Berkeley's great, Ohio State does a good job, Michigan does a good job. It's just the economics, right? So as Fletcher said this morning, it's just the economics that drives that behavior, and the universities just aren't set up as commercial entities. So I don't know how you would. I mean, maybe there's a legal way to do it, but the way that most funds work is there's a percent commission and then a carry or a promote, and I don't know how you would do it internal to a for-profit entity inside of a nonprofit entity. I don't know how that works.
Yeah.
And I think they run into those problems with corporate venture groups as well.
Yeah.
And there's been a rise in corporate venture, but we're also at the tail end of a big upcycle, right? So those usually come in waves as well. But what happens is you're a biz dev VP and you start up a fund within your corporation and you make some investments, and all of a sudden you sell a company, and now I make 10 times more than any of my peers in that corporation, and word gets out, right? And it creates a lot of problems.
I think the other thing that it stifles transparency, and I think what this is critical. So like the entire underpinning of this is that you got to be communicative. So if this is only going to benefit one group and not the alumni group or the philanthropic group or the donor development group or whatever, you're totally and utterly screwed. So the the underlying fundamental thing that has to happen is that you have to want to be in the commercial business. Not say it, but do it,
Yeah.
right? So you have to hire the right people, you have to incent them the right way, and then if something goes wrong inside the university, the odds are if you lose someone a lot of money, they are not going to be a long-term donor.
Yeah.
Now, businesses fail all the time. All the time. I mean, I don't know, I mean, the stats, but I mean, it's how you handle it. It's much easier to say, I gave $1 million to these clowns over here, and they did a bad job, than the University of Kentucky lost my money. And I don't think the appetite from presidents that we've seen, and most people in this room, I said it at dinner last night, on the 5 things that are always on that annual report the president puts out, it looks like it's been like copied by every single one of them. They are like sustainability, security, innovation. So they're all the same, and there are very few that have the ability to really break out of that mold. And I don't think that starting a venture fund internally would there's first of all there's very few that even would do it.
So the important thing you're mentioning, first of all, aligning incentives. So really being careful about what the rules of the game are that you're setting up, right? So make sure incentives are aligned. Second, I would say, is long-term perspective, right? It's funny when you watch people kind of fighting over some future success that hasn't happened yet, right? Like greed comes out. So, yeah, the odds are still low of that kind of success, and that's why you want the incentives set up right. You want commercial partners and others that are willing to gamble, roll the dice, take a chance to make something happen. And as long as you're set up long term, that everybody wins, right? Again, it's no different. I think Silicon Valley does a great job of this. Again, in the corporate world, in terms of just their M&A, right? The world's moving so fast. They're happy to buy a company later for $100 million after it's been de-risked, instead of trying to develop it in-house. Because it takes too long to develop it in-house.
It's like
The incentives aren't lined up.
1 out of 18, I think, is the normal. What would you, like when you were talking to investors, what was your profile on pure venture? Say maybe 1 out of 18 hits, and maybe 1 out of 15. What was your ratio?
Yeah, 1 out of 20.
Yeah. So if you look at that, the only way to de-risk that is by saying I'm going to arbitrage some IP, which you guys have a plentiful environment of, but most venture companies don't have that option.
Actually, the other stat, back to your point about losing, the typical write-off rate in the venture fund is 40% on a deal basis. So if you do 20 deals, 40% of them for zero, don't return the money. That's just the name of the game. Bill Gurley from Benchmark, has a great quote, which is the venture game's a grand slam business, not a home run business.
Yeah. So I'm glad you knocked that softball out of the park. I appreciate that one, both you guys. So, and actually, my last question before we open it up for audience questions was going to be on, is it short-term or long-term expectations, right? And you kind of let us off there down that path. But let's continue that. What I want to do is go each of you guys to speak to if a university was going to make a decision to go down this path. Should the expectations, because so we've heard Fletcher just talk about in 31 months have a couple of exits, or at least one, and 2 more coming. But I want to make sure expectations are managed appropriately here, and we talk about should the expectations be short-term or long-term, and then maybe if you can take one, and we'll start with Mike, just take one thing you can tell us all. What do you think is most impactful, right, about doing this, especially given your model is sort of deal-focused?
Yeah, no, absolutely. So I mean, our model really has to be long-term. So going back to something I did before when I was started doing crowdfunding, the initial deal that we did to raise $350,000 took 9 months. And every single institutional capital partner we had was laughing their ass off. They were like, this is the dumbest thing we've ever seen. It took that long to do that. You could have picked up the phone and raised $10 million. What are you doing? Right? Fast forward 2 years, the company was it raised well over $200 million, and within posting something on the platform, it was raising millions of dollars in minutes. So, I mean, our approach is wholly based on long-term, based on plugging into the existing things that the university is already doing and creating positive feedback loops. So that experience is incredible, but I don't know that that's what you want to anchor expectations to because of the failure rates.
What's an example of a long-term decision trade-off you've made versus the short-term?
Fees. How much we charge investors has been one of the biggest ones. We're not looking at raising a huge amount of money in kind of fund one or fund two, so the unit economics for our business right now don't work.
So
Right.
you're resisting the urge to kind of be greedy now. This is a downfall of most venture firms, right? They make so much money in the management fees that whether their investments win or lose, they don't care.
That's right.
Whereas a good performing fund that does what they say they're going to do,
Incentives.
they only spend about a week fundraising
That's
instead of
right.
9 months or 12 months or 24 months. And so they give up the fee, but they're going for the long-term downside.
That's right. And the fees on a $20 million fund to begin with can only be so much, but the fees, once you start getting into the $100 million, $1 billion numbers, you know, you can take a basis point or less in terms of annual fees, and do just fine. So I'd say that's been one of the biggest ones. Another one has been, right now, we're seeing a lot of people kind of starving for investment opportunities. So we definitely have had more people who want to deploy money than things that we're comfortable investing in. So resisting the temptation to say, we're going to put money into something that we don't think is likely to return it.
Yeah. Thanks, Mike. Tim, you just talked to the long term. I think we know where you sit on that, but maybe sort of the biggest impact that you could see if every university in the country went down this path.
Yeah, so it's long-term and alignment. So there was a lot of discussion this morning, I think, in terms of the alumni associations and philanthropy and not getting into the turf wars and bringing in investors that ultimately will have a much bigger impact on the community. But often I run into this buzzsaw, I'll say, at universities when I talk to them. And matter of fact, for the program we're doing, we're looking for a little bit of money to help fund and recruit some of the talent. And as soon as some of that money shows up, and development folks, everybody else are all over it. So I think that's short term, but I understand the challenge. It's a big challenge in a big organization. I think many big organizations face those short term decision pressures, right? People's compensation, bonus, incentives, other things are all tied to that. So I think you have to work especially hard at trying to articulate the long term advantage and put some metrics behind it and be realistic about it. So, keep in mind, venture firms, you raise a fund, it has a 10-year life, right? And also just to give you a metric, the top tier venture funds return about 3 times the fund, right? Something like 90% or so of funds don't return the capital, right? So it takes a long time. You might get a 100-bagger, but you're going to lose on the other 99 companies, right? So, be realistic in terms of expectations for the long term of what's going to happen and what it takes to set up that success. Because you're playing a 20, 30, 40, 50-year game ultimately.
That's a good point.
I'm a little bit different in the sense I'll say short term and long term. Most university officials that I'm aware of, whether it be athletic director or president, and there are Mitch Barner is a totally anomaly. 15 years in one place just doesn't really. I mean, it's crazy. He's great, but so most people get distracted after a couple of years and they move on. So our thesis is that we have to have a short-term initiative and a long-term initiative. Fletcher mentioned that he got Bobby Robbins, and he and both Bobby have said, look, we're going to do this for 10 years. Fletcher's 69. I don't think he must be hanging out at 79 doing this, but I think ultimately it is a 10-year hold, but we're trying to arbitrage the IP for opportunities that are quicker. And so we don't need to sit around with a 10-year mandate and just wait for the exit. There are a handful of big funds in the university space that raised $400 or $500, $600 million bucks, and they've been around 5-6 years with no activity, none. So our thesis is a bit bridged between, Fletcher has made a commitment about making this a multi-generational platform. He wants to have a succession plan so that the next generation can come, which aligns with what Tim said, having aligned incentives. But the truth is that we have to have short-term initiatives to keep people's attention.
However, those are still work in the context of the long term, right? So,
Sure.
For example, you're not going to make investments you don't think are.
No, we're not.
You're not going to agree to a budget of we're going to do 5 investments a year.
No, but in Arizona, now to your point, it's really the opposite, is that there's been so much pent-up demand, there's not enough capital to supply that. So in a normal situation, all of these are for the profile of the right exit. Like, there's just not going to be a bad decision made, though, because it just, the core thing I want everybody to know that we're about is we're about helping you make money. And I think Tim would say the same thing, and Michael would too, is that it's all about the return, and the ability for reputational impact is critical, but the only way to continue to change that reputation is to continue to have success.
Thanks, guys. Appreciate it. We got about 10 minutes for any questions from the crowd. Anyone in the audience have any questions? Yeah, James.
I'll have a little bit.
Thanks.
So have you guys seen venture funds that aren't really venture funds in academia where the alumni are donating back to them? They're really more translational funds to get to the point where you would invest. Are you seeing anywhere doing that and we're doing it well? It's basically donation from philanthropy. The funds are then used to move science to the point where you might actually look at it more at deeper city, get to the point where your funds might look at it more. Are you seeing anywhere doing that? Doing it well?
There's a lot of, I mean, Arizona gets about 700 million,
Right.
and mostly NIH and DARPA. I'm not familiar with the gifting into a specific life science or biotech where then it would then be generating interest. I'm just not that familiar with it, but I do know that every university at every level has a venture initiative, some different stripes, and an angel community. So I'm sure that's out there.
Yeah, so I've seen a number of those. UMass has one, NC State, Clemson, UNC, Chapel Hill.
Who are the best?
It's hard to say. I mean, they're all kind of around, I think the average check size I've seen from those is around $50,000, and the average size of the fund is around $1 million. So in a lot of cases, they're going to fund like initial startup costs for kind of IP that's incredibly nascent. So it doesn't look and feel like investment money, and I don't think they necessarily look at it that way. To me, from my standpoint, all of them have these big steering committees and advisory committees, and it's a lot of work for $50,000 checks that ultimately aren't returning much. I haven't seen any that I've been like, but I mean they're early too. I mean all these are within the last 5 or so years.
That's a good question. Any others? Yeah, Bob?
So for a lot, so you're trying to raise 100 million. We were talking about this earlier. Do you really think you're gonna? So how long a period of time? I think I heard 10 years. You're gonna look at
Well, the hold is 10 years.
The
The hold is by contract or
Okay.
subscription agreement.
But do you really think that Arizona's one school you're gonna be able to place $100 million? There's that much stuff coming
Well,
out of that school?
just to give you an example, so they had, Fund 1 was around 20 million, they deployed the entire capital last year. And I think 11 or 12 companies. We've already raised somewhere in the neighborhood of 20, 25. I don't know the specific numbers as of today. After Tim's commitment, it's probably 28 now. The answer is, they got 225 licenses last year. I think Fletcher could probably deploy 500 million. Problem being is that at 2 million and 4 million and 5 million clips, Tim will tell you this, it's just not reasonable. Like the subject matter experts you have to bring in to look at that kind of valuation, that's a problem. So I think 100 million is probably the level, unless you really, really expand the sort of the professional network, Fletcher's individual network. But yes, I do believe we'll close 100 million by November. And I think that they will deploy it. The capital call is 50% up front. There's so much demand, they'll deploy 50% upon closing, and then as needed, the other 50%. So the specific answer to your question is, if I had a magic wand and could get 10 institutions interested, I think he could probably take up to 500 million. I mean, look, think the 700 million of research that's currently being deployed has created 1,350 patent filings since 2013.
And I think the other side of that, Bob, also is Arizona Tech Launch, the commercialization unit of Arizona, is very well resourced and equipped also. They got a large team, big buzzsaw, big engine.
Well,
They run a
I
pipeline.
understand all that, I know some people there, but the issue is, I know the kind of technology that comes out, we file a lot of patents too. We don't get a lot of invention, but we file a lot of patents, but the stuff is so nascent. And so, you're talking about placing money responsibly, and you're not gonna just fund anything, invest in anything. And so really, is it really gonna be that much fundable stuff coming out of one source? That was really the question.
Yeah, I think, and I don't know this exact number, you guys might know what Michigan did last year. You guys put 100 million to work, right? Okay, so Ohio State put 100 million to work.
Anything Michigan does is also on computers.
Yeah.
Will it return 300 million?
Yeah, that's right, that's right. But I think the answer to your question is, I think, I don't want to break any NDAs. I think there's something like 6 or 7 companies right now under LOI that could get immediately funded with the current capital they have deployed. And I would encourage everybody who's here to go out to Tucson. They've got 2 million square feet of space that they got from IBM as part of they took over an office park. It's unbelievable. It's just a unique set of circumstances, and I do believe they can deploy that capital. But it's going to be a burden for Fletcher.
Yeah, Warren.
So, the majority of the time we talked about are funds that are including accredited investors. But you do have, and I know we talked a little bit about the non-accredited investor and the new rules. Do they have to be kept, I'm assuming they have to be kept in separate funds. Could this be used to take people who want to invest in, not quite, just like you have a company you're trying to build toward the pipeline to be invested in. Can you use as a way to build your investor base by taking the non-accredited investor fund to do the early stage funding? But the idea, we want to get you to the point you will be wanting to invest. In some of these companies, you will invest in this second fund.
Yeah, you absolutely can. So you can raise money for a fund using one exemption. Reg D is what people usually use for accrediteds. And you can use a totally separate exemption and have a different offering for unaccredited investors on the same fund. The issue is one of just economics. So when you do that, you have to go through a qualification process up front with the SEC. There's a comment period back and forth. Lawyers like making money, so it's not super inexpensive. So you need, generally, so when I did the $50 million raise, that one, our filing fees, our lawyer fees were around $500,000. So about 1% of money raised.
Because of the certification process?
The qualification process. But the difference was when you do a traditional IPO, your underwriting costs are around 6 to 8% capital raise. So when you look at it through that context, 1%, the traditional roadshow process that we're talking about is all online, right? So if you look at that 6 to 8% that you're paying to an investment bank, that's all returned to the investor. So the economics can be better, but it requires a certain amount of scale to make sense. It's not something that you go out and do to raise $1 million.
Yeah, I'll add on to that for us, we wouldn't do unaccredited because we have a 8% coupon, which is really, really unusual in venture.
Right.
So it's a preferred coupon. It just wouldn't make sense for us to have the non-accredited investor.
Could you fashion that first fund as a true, and I ask my philanthropy folks in the room, as a true gift fund that they're giving to help early stage startups, but with an underlying marketing toward them, these will be ones down the road that you may be interested in this other fund when you come out.
When you want it the other way though, to maybe make because you want the investment funds to then become gifts.
I don't know the answer to that.
It's like a donor advised fund, perhaps, where you're giving to a foundation that then in turn is going and investing.
Yes.
Returns flowing back into the fund.
For that early stage stuff that is needed, because we were talking to children, they're saying they're so early, if you can find a way to fund that, it keeps your deal flow going for the other funds.
I wouldn't want the donor group making the investment decisions, the foundation group making the investment decisions.
That gets back to what I mentioned earlier about talent versus capital availability. You really don't. I think there are ways to capture the capital. You gotta solve the talent problem first, right? Especially things, this is where so many accelerators and other events I've done with universities, and whether it's a small investment or a prize of $50,000 or $100,000, like, what does that get you?
Right.
Like, spend $100,000 or so on recruiting fees, right, to bring somebody into the team. That'll get you a whole lot farther,
That's true.
right? So, I think we need to change the way we look at that.
Yeah, I'd give Ian a raise, and then I would have him focus more on how to build a commercial fund.
You're hired. Go ahead. Sir. All right. I'm going to cut us off here. We've all spent a lot of time together. I want to thank our panelists for an awesome panel. To everyone in the room, thanks for coming. I mean, this was a really, really interesting conversation to have, and all the people in the room. We do have cocktails.